All right, what's up, Craig? We're live here on Facebook, and what's up, everybody? How's everybody doing today? It's Wednesday. Obviously, we're going to continue doing these live broadcasts. Craig saying hi to you guys. Hopefully, everyone's having a great day. Today, the agenda is the current real estate market that we're in. I'm sure you guys know, you're seeing it. It's a seller's market, and we're going to kind of go over what's causing that. The lack of inventory, which essentially is making it a seller's market. We're going to talk about what we're seeing, and we're going to talk about how a buyer can overcome obstacles that are caused by current market conditions. And then pretty much answer any questions that you guys might have. So that's kind of the agenda. I'd like to start by saying it is a seller's market, and it's mainly because we have a lack of inventory. And based on what we're seeing here is to kind of compare the current inventory to months or years in the past, we're pretty much at a 3-month supply. And what that means is that if homes were to stop going on the market, what's currently listed would be sold in a matter of 3 months. In a typical market, somewhere around 6 months supply. So what that tells me is that the inventory is selling twice as fast, or there's half the amount of inventory right now in its current market. And we're going to kind of go over that. So Craig, if you just want to introduce yourself really quick for people watching this that weren't on last week.
What's up, guys? This is Craig. I'm Brad's business partner, and I handle all of the loan consultations in our branch. So yeah, we're going to give you some some things that we're seeing in the market, and go over some details on how to possibly overcome some challenges that you have as a buyer in a seller's market.
Awesome. So I got to mention, Craig, I love these emojis we have at the bottom. We're a little bit more prepared than we were last week. We're Facebook Live official.
This guy has a hat on. I need my Green Eagles hat too.
So let's talk about we obviously understand that we have a lack of inventory, which is causing the high demand, and obviously the increase in prices, and making this a seller's market. Why don't we start by talking about what's causing the lack of inventory, Craig?
I think like any bubble, so to speak, there's major events that have occurred that have caused a buyer's or seller's market, right? If we're talking about the market that we're currently in, we had a major event, the pandemic, and there's certain things that affect the lack of inventory, so to speak, and that would be mostly by, or not mostly, but prevention of foreclosures. Right now, I believe there's a moratorium still active for foreclosures, meaning a bank can't foreclose against the property. Those properties that would normally be on the market and being listed and sold, those properties are unavailable. And that's why you don't see, currently I don't see a lot of contracts where banks are actually sellers of properties. So you can feel the effect, and that basically causes less properties out in the market. And another thing would be a prevention of evictions from a landlord standpoint. If somebody can't be evicted from their property and they want to sell, that prevents the seller from being able to put that property on the market. And I don't know the deadline, so to speak, but in terms of what has caused this up to this point since the pandemic, that's two major contributing factors on why there's lack of inventory. We also have a substantial decrease in interest rates. The government stepped in to help try to artificially drive interest rates down. And, how does that affect the seller? Well, if you own a property and you want to refinance your home, obviously you just refinanced, you're in a better position. You may not be motivated to sell your property at that point. Another point would be is buyers going out, jumping on the buyer bandwagon. I don't know if you want to explain that. You kind of wrote that down, Brad.
Yeah,
What you meant by that.
Yeah. So basically, first to go back, we have moratoriums that were put in place that is preventing banks from foreclosing on people and also protecting renters from being evicted, obviously because of the pandemic, right? So naturally, regardless of what interest rates are, what housing prices are, naturally people are foreclosing, right? It's happening naturally. So we have a lack of inventory because you have that part of the real estate that's available are foreclosures, and that's completely gone right now. And then we have the fact that you're saying is that people can't be evicted, or it's harder to evict people. I think I was reading that it's not a federal mandate like in New Jersey. It's New Jersey mandated. They're not allowing people to be evicted, and it could have been, maybe they've changed that or they're going to be changing that soon. But if people can't be evicted, then landlords can't sell their homes, which is also part of the market in a normal real estate market. So those two things are obviously creating a lack of inventory. Interest rates, as you mentioned, people are less likely to sell their home right now because of the increased equity that's caused by the inventory, right? And people overpaying for houses. So people are less likely to sell their homes because now they have equity where they can make renovation improvements. Interest rates are super low, and people are locking into those lower interest rates. I mean, how many people refinanced last year into like a 2%, 2.5%, 3% interest rate? And now it's like, where's the incentive of selling a home right now when you're locked into this historically low interest rate and you have equity to make the additional improvements that are needed? So now maybe they're not enticed as much to go out and buy that bigger home, right? Also, as you mentioned, the bandwagon thing, right? There's a lot of people jumping on the buyer bandwagon. I mean, we have probably 100 people that are pre-approved and looking at homes right now because people don't want to miss out on this low interest rate, opportunity, right? And we're going to go over that at the very end of our live feed, guys. Craig is going to give us a real life example of what the cost of waiting is. And I think that's the thing is you're seeing more buyers in the market. You're also seeing millennials that are starting to buy homes, or they're at that age where they don't want to rent anymore and they're trying to take advantage of these low interest rates. So I guess that's what I meant in the notes by the bandwagon.
I'm sorry, I didn't realize where you were going with that. But another thing that we probably didn't mention is the fear factor, right? As a seller, maybe you're fearful that, am I going to be able to find a home that's affordable, better than the home that I have because of rising prices, right? Nobody wants to sell their home, have no place to live. I got to live with my in-laws. I got to live temporarily and rent something out. It's great to cash in on the equity, but where am I going to move? Where's my new housing going to be because of this lack of inventory? Am I going to find something better than what I have right now? So that fear factor also plays a part. And just kind of the effects. That's our next bullet point is, what are some of the effects of this type of market on purchase transactions? Obviously, we're seeing multiple offers on properties. It's not uncommon to see 10, 15 different offers on properties right now. And that kind of lessens your chance to get an offer accepted. Discouraged buyers, right? It's not exactly fun to go out and make tons of different offers and keep getting turned down. And it takes time, right? You got to go out and look at houses. You got to talk to your agent. It's almost like a second job to be looking for a house. And you can easily get discouraged and say, hey, I'm just going to hold off on this buying thing, which might not be a good move. Overpaying for houses. This happens significantly. I mean, we're seeing this more than I've ever seen in, 17, 18 years of doing loans.
Yeah, even to the point where people are buying homes and the appraisals in some cases aren't coming in, and there's a gap between what they're buying it for and what it's actually worth.
Yeah, significantly paying over the asking price of a property, or more than what the house is worth. Correct. Quick closing date requirements. Typically, you're trying to put your best foot forward when making an offer, and you might see 3-week closing requirements, no mortgage contingency. And this, puts stress on you as a buyer to, get documentation to your lender, resolve issues, and have this all happen without any mistakes going on. And, that I would say takes at least typically 30 days to close on a transaction. And sometimes you're seeing a lot quicker closing turnaround times. And then the last thing is waiving contingencies. This is happening frequently, where you're waiving the appraisal. So no matter what the appraised value is, you're willing to pay, the difference between what the appraised value is and what the actual price is on the contract. Home inspections, sellers selling properties as is. I mean, typically in a contract, you should be able to, have a home inspection done, and then in a required period of time, you can request from the seller to make certain repairs up to a certain amount of money agreed upon between buyer and seller. So all these things that we would normally, in a normal market, you wouldn't see this. This is kind of, what you're dealing with as a buyer in a seller's market. So we could touch base, or Brad, you want to touch base on how you might be able to overcome some of those obstacles in the current market that we're in?
Yeah, I mean, so that's kind of like what we're seeing, right? These are the obstacles that we are, or our clients are dealing with, and, I think the reality is they're not going to go away. They're obstacles. They're going to stay there for a while, at least until the inventory changes. But for right now, we have to figure out the best way to navigate these obstacles. What we do here is we create a clear mortgage plan. So it's really, I guess, just understanding. I'd like to start just by saying that you need to understand the seller's motivation, right? So, as far as like the offer amount, like when you're making an offer, you have to offer something that's going to be attractive to them. So like in previous markets, and I mean, I started doing this in 2009, like after the collapse of that bubble, and there were short sales, there were foreclosures, there were, huge price reductions. So for a long time, buyers had that mentality where they wanted to make an offer and, offer a lot less than what the house is listed for. That mentality is gone. Like, and if you have it, you need to change it, right? So you got to be understanding the seller's motivation. They know they can get more for their house right now than ever. So you have to understand that and come correct when you're making an offer.
It doesn't mean that you can't make an offer, right? You can offer whatever you want. It's what's the likelihood that offer is going to be accepted, right? So you just got to keep in mind that you don't want to waste time, right? So, and I feel like that's the biggest thing is saving your time, because your time is valuable.
Yeah. So exactly. So again, it's really about what the seller wants. So you got to consider that, right? Where their head's at. Loan type. A lot of sellers are wanting people that are doing conventional financing and higher down payments, opposed to your other traditional mortgage products like FHA or the state programs or VA or USDA. And it's sad to say, because those are all great programs. And a lot of times it's because the sellers don't understand how those programs work, So either way, it is loan type. They're looking for a certain type of loan on the offers. I've just had a conversation with a gentleman yesterday about the two offers he got, FHA and conventional, and how he was more willing to take the conventional offer because they're making more of a down payment. They have more skin in the game, right? The seller is also looking for less contingencies. So if you can make an offer with no contingencies, meaning you don't have a house to sell, or you don't need a seller assist, or the different contingencies that come along with it, waiving the appraisal, that's a contingency. If you're willing to waive an appraisal, then that's going to help you get the offer, right? Or waiving inspections, right? Not to say that you're not going to get an inspection, but you're going to waive them fixing or making repairs up to a certain amount. I guess you got to make sure the house is habitable. Obviously, do your own due diligence. Earnest money deposit, that's huge. When a seller sees that you're willing to put more money down on the contract, it's going to help you get that house because you're putting more skin in the game. You're less risky in their eyes. And also down payment. That goes back to the conventional loan. We talked about this last week. You could do a conventional loan, maximum financing all the way up to 97%, right? Which means as little as a 3% down payment. However, when a seller sees that you're making a larger down payment, it does two things. Number one, it shows them that you're capable of making up for an appraisal gap. So somebody making a 20% down payment might be able to, now if the appraisal comes in light, they can switch their financing where the down payment requirement's only 5% by the lender, and now they can use that difference to make up the gap for the appraisal. But also they have more assets saved, so they're just less risky of a buyer, and they're going to be more willing to go with that offer. And look, everybody's situation is different. Some people have more saved than others, and that's kind of our goal here, is to help you guys be competitive in the market, look at what options are available to you, so that, as Craig said earlier, you're putting your best foot forward. The second thing I want to mention, and that's just understanding how a seller thinks, understanding their mentality. The next thing I want to talk about is, taking your realtor's advice. You guys got to do your homework and make sure you're working with the right realtor. There's an actual statistic out there, Craig, I don't know if you know this, but there's more realtors than houses available to sell. Like, the inventory is actually lower. So there's not even enough houses for every realtor to have a listing right now. It's a crazy number. So what that means is a lot of people are coming into this market that are new, and we've all been there. Some people are part-time. So make sure you're working with a professional. If you guys need help with that, we know a lot of great agents locally and outside of New Jersey even. But it's very important you're working with the right realtor. And if you are, and you are, you got to take that person's advice, right? Just like if you take your car to the shop, to the mechanic, if they tell you need new brakes, you're not going to think about it, right? You're going to get new brakes because they're advising you to do it, and they know what they're talking about, and that. So if your realtor is giving you advice to make an offer at a certain amount because they think it's going to increase the likelihood of buying that house or getting that house, you need to take that advice. And if you're not willing to take your realtor's advice, then that leads me to believe two things. Either you're not as serious as you're telling them you are, or you're not confident in your realtor and you're thinking that they might be giving you bad advice. So that's kind of what I think. I really think that taking your realtor's advice is a great idea. That's what I would do personally. Another thing is making an offer, doing like a worst case scenario assessment. So what I mean by that is kind of like what I touched on earlier, is that if you're going to make an offer, if I'm a seller or a selling agent, I'm looking for more documentation, or I'm sorry, if I'm a seller or a listing agent, I'm looking for more documentation from the buyer or the buyer's agent. So what I mean by that is, like, if I get an offer from one buyer that they're qualified for 20% down on a conventional loan, that's great. But now if I got another offer from another buyer's agent that they're qualified for a 20% down loan on, let's say, a $300,000 sales price, and that's what they're offering me, but then I also get a CMA from the realtor saying, hey, listen, we did our due diligence and we think it's going to,
Explain what a CMA is, Brad.
It's basically like an assessment, a property assessment, a comparative market analysis is what it stands for. Thanks, Craig. Sorry. A comparative market analysis. So your realtor is going to actually study the market prior to you making an offer and making sure that the offer you're making, the house is going to appraise, right? So my thought is that in a lot of situations, we're seeing that the appraisals are not justifying the offer price, right? So if I'm a real estate agent making an offer in this market, I might send a pre-approval for $300,000, but then I also might send a CMA that justifies a $275,000 value, and then send an additional pre-approval that says, hey, listen, we're pre-approved up to $300,000. Here's where we're seeing the house might appraise at, and here's an additional pre-approval because we've already done our homework and our due diligence that if this house under appraises, we already have a backup plan, right?
We already have gone over that structure of types of financing to make up for the difference in price if it does come out at that CMA, that the estimated value, so to speak, right?
Yeah.
So, and I think even more so is if you're a buyer, you're prepared for those different outcomes, right? What's my cost of my monthly payment at this scenario? What's my cost of my monthly payment at a higher amount, so that you can game plan for this? And this is done prior to you making an offer on a property. And you want to be educated. The good thing is that we have reports that do all this. We can contact you once a week once you're pre-approved, and we can put together reports based on the CMA value, and also what the potential offer price is, and put out 2 pre-approval letters. So I feel like that's pretty good. It's pretty good advice in a sense, to be prepared for that scenario, and you're not going in blind and trying to kind of crunch numbers with a small amount of time for a seller to make a decision on whose offer they're going to accept.
And that's the thing too, because a lot of people might be putting 20% down because they have to. Maybe they don't qualify to borrow more, right? Or maybe that's not the case, but maybe they don't have anything beyond that too. So it's almost like you could be putting down less, but if you show them that you have a contingency plan, your offer might be stronger than somebody putting down 20%, because still that's vague. Like the listing agent's not getting bank statements. The listing agent doesn't know what that person's debt to income ratios are. The listing agent doesn't know if they need to put 20% down, because not only are they financing less, but they're not paying that mortgage insurance premium, and both financing more and the mortgage insurance premium are things that will increase their debt to income. So you can't judge a book by its. I think that to be aggressive and competitive in this market, the more you supply as far as upfront information to a listing agent, it's going to increase the likelihood of you getting the house, right? So making your offer stand out was another good point on how to overcome these obstacles. We kind of went over that: the CMA, the pre-approval, at the offer price and then also the pre-approval at the worst case scenario if the house under appraises.
Explain to them about like a lender brag video. And I feel like this is unique. This is that extra mile, so to speak, that your lender can go to help you get that little bit of edge if you're talking about an offer that's the same offer, essentially, right? How do you stand out compared to somebody that has the same exact offer?
Yeah, so that's another way. That's a lender brag video. This is something that we're offering. We're letting our agents know about it. In this market, sometimes it's just things are happening too fast. We're not doing as many of these as we would like, but the reality is, when you're working with us, we're willing to do a brag video about you, the client. Now, there's certain laws in real estate, and look, you guys can definitely stump me if you'd like. If you're a realtor watching this, we are lenders. We're not licensed realtors. We're just trying to find out ways to make our clients more aggressive and competitive in this market and help our referral partners. But what I strongly suggest is, I don't think there's anything that's incompliant about me sending a video, or Craig sending a video directly to the listing agent, introducing himself, and then also bragging about you as a client. There's no other lenders out there really doing this. This is something that we're willing to do. So it would be a lot like this. Hey, my name is Brad. Nice to meet you, Mr. Listing Agent. Just wanted to let you know you probably recently received an offer from my client, Joey Bag of Donuts. And just wanted to let you know, Joey is like an A+ borrower, has high credit scores, low debt to income ratios, has assets, and even more assets available if the house was to under appraise. You probably received information as well from the buyer's agent that we've done our due diligence where we think the appraisal is going to land at. And we have, obviously looked at that situation, and we've come up with an alternative financing solution for if that was to happen. Now they're getting a CMA, they're getting the pre-approval for the offer price, they're getting a pre-approval for the lower value if that's to happen, and now they're getting a brag video from the lender. I'm inclined to believe that if I'm a listing agent, I'm taking that offer all day, because at the end of the day, you removed all doubt. The only thing left now for negotiating is inspections, right? And the actual sales price itself. So if you're taking your realtor's advice up front and you're making a competitive offer, that removes the offer price issue, and now it's just left on inspections. And typically your agent's going to know up front, and you're going to have, you're going to look at the house and see if there's anything really wrong with it. And then at that point, you're just getting an inspection, I guess, to cover yourself in case there's any foundational or major structural issues, So again, we're not licensed real estate agents. We're just trying to advise and give suggestions and tips here, right? I think the next way to overcome obstacles is choosing the right lender. Craig, why don't you talk about that, since you're doing all of our mortgage consultations? Maybe talk about why working with us or a lender like us that's local is in a buyer's benefit.
Well, I think that and most agents will attest to this, that, and there's nothing against big banks or non-local lenders, but it's difficult if you're talking about multiple offers and you're a seller and you're a seasoned agent and you're trying to represent your client and you get a pre-approval letter from California. I'm going to tell you right now, if you're in New Jersey, you're probably willing to work with somebody that you know, like, and trust, whether it's an agent that you're working with on the other side, a selling agent, or it's a lender that you know of. So I feel like that's important. And like I said, obviously the idea here is to get, if you're a buyer, is to get the best financing options for you. That's the most important part. But in most cases, lenders locally, we all have the same rates, basically, in a sense, same cost. So having a local lender would help you in this instance, because maybe they know, our process. Maybe they know that we've resolved issues in the past and we close deals on time and we meet those markers and they like working with us. So that gives you some competitive advantage if the listing agent knows who you're working with. Also, a part of our process is going over all of the options, and we do a total cost analysis report prior to your pre-approval and kind of break down your cost involved, your monthly payment, and all the programs that are available to you, not just one program, so that you understand, even if you don't qualify, you understand why one loan is better than the other. So you can kind of visualize that. And that gives you confidence and gives your agent confidence. Communication is super big. I feel like our process, if you're not able to communicate with your lender, bigger banks have this issue a lot. Like, you might talk to a loan officer and then you're not dealing with them throughout the whole process. With our pre-approval process, I handle all the consultations. So I'm continuously communicating with people from when they're pre-approved until the end, and when they close and get the keys in their hand. We have other team members that obviously facilitate that, but we're consistently making sure that we have markers in our process to make sure you're getting all the information that you need. So once you're pre-approved, we're going to contact you once a week to follow up with you on any changes that you might have going into a weekend. And you're maybe looking at a property, maybe you need to revise that letter. Maybe you need to look at different options on price ranges and monthly payment. On a Thursday, you get that. You're getting that information before you even go on the weekend and look at houses, which is important. The other part is when you're under contract, we're contacting your agent. We're making sure you and your agent are getting feedback once a week, and you're getting contacted in the process to address any questions that you have. And then additionally, we also have milestone markers in our process that
I'm gonna count them.
that show where you're at through the steps in the process. So if you take an application, we're sending that email notification to you and telling you what your next steps are in the process. If you're under contract, you're getting an email notification, and you're knowing where you're at in the next step of the process. So all these things are good in finding out where you're at, and it leads to good communication. So
yeah, I mean, and look, just to kind of touch on that, I think it's great, and I like messing with you, Craig. I had you laughing there a little bit, it looked like. But I was talking to somebody yesterday, a friend of mine, Jen, and she had mentioned it. Like, people when you don't hear from people, people associate that with a bad thing, right? Like there's nothing good to tell me, so that's why I haven't heard from them, right? So that's kind of why we do that, is because we want to communicate the process entirely. Like, we're going to notify our clients every time an important milestone is met, even as far as where they're getting a video email from us explaining the step in the process and the next. But the listing agent and buying agent are also copied on those emails. And then, like you said, we're doing these weekly updates to all parties involved. And the reason why is because sometimes we don't have any news to deliver at all, but we always want the communication lines open. So we always want people hearing from us, because then they can't assume that there's bad things going on, right? So that's, just to kind of elaborate on what you were saying, it's definitely communication. And I think that's where we pride ourselves. And a lot of banks also do, but there's a lot of banks out there that don't, right? So I agree with everything you said. Choosing the right lender definitely comes down to the relationship. It's going to help maybe win an offer. Like, I had an agent call me yesterday where they were considering our buyer's offer because we've worked together before. So it's kind of like that doubt, right? Like, okay, this offer might be a little bit more attractive, but I don't know who this internet bank is. I don't know if they've validated all this information. I don't know if they're going to be able to close on time or at all, for that matter. So you definitely want to pick someone that has local relationships and that's going to communicate the process, because when it comes down to interest rate and programs available, every bank's pretty much offering the same thing. We have to be competitive, or else we're going to price ourselves right out of the market. So definitely some things to think about, right? And we kind of talked on it earlier. Your agent, you got to rely on your agent. Use somebody that knows the market well, too. You want them to be local, because if you have an agent that's an hour and a half away showing you properties in this town, they really don't know this town very well. So
let's see if we can answer some questions, Brad. I don't know if Kristen has any questions, or if anybody's on. Otherwise, we can kind of get right into that report that we were.
I don't know what Kristen's doing, but the only questions I've gotten so far is, I'm thinking about selling my house, but I'm worried that I won't be able to find anything. So do you want me to take that, or?
Yeah, go ahead, Brad.
Yeah. So the one thing I'll say is that sellers are protected. It's going to be a lot easier to have contingencies that protect you versus the buyer, right? Like, so if you're making an offer as a buyer, people might not be willing to accept your offer with contingencies. But as a seller, because of the lack of inventory, you could market your property, get it under contract, and then there's something called a seller contingency, which that's my name for it. It might be called something different, but essentially you could sell your home and put it under contract with a contingency in the contract that prevents you from having to close on that specified date if you don't find suitable housing, right? So now, if you need to sell your house to qualify, you're going to have a contingency, but your contingency might look a little bit less weak or more stronger if you're saying, hey, listen, I have to sell my house, but by the way, it's been under contract for 60 days and my client already has a mortgage approval. The only reason they're not cleared is because we haven't had an appraisal done, obviously, right? So that's a great way. If you're thinking about buying a house or selling your house in this market, you can protect yourself. Right?
So let's try to get to this report, just because I have a consultation coming up, Brad.
All right. Yeah, let's. So we're just going to really quick. Craig's going to kind of show you, if you're thinking about buying a house right now and maybe discouraged by inventory or what have you. He just wants to kind of show you what the cost of waiting would look like. So I'm going to pull this report up, Craig.
Cool. So, and tell me if you see me highlighting, Brad.
Yeah, you're good.
All right. So we have a couple different options up here. We have a buy now option, like what the interest rate is, the price of a house might be. And then your thought process is obviously I want to wait to buy a property to see if the price drops. But in doing that, you might have the potential of increased interest rates. So for this one, the first option, we have a $300,000 sales price. You're putting down 20%, which gives you a loan amount of $240,000, estimated interest rate at 3.25%. You can see your payment right here is $1,807. right? And this is the total cash to close, which includes estimated settlement fees and down payment. If for some reason, let's just say you want to wait 12 months, right? And the interest rates go up by 0.5%, but the price ranges went down $10,000, right? How does that affect your ability to buy, number one, or your monthly payment and cash to close, right? So we have the same deal where we have a $290,000 sales price with the interest rate going up by 0.5%, right? Only 0.5%, not, incredibly higher. Your cash to close would be a little bit less, right? Under 2,000, and your payment went up $4. So waiting for the market to drop, right? $10,000, your payment is actually higher. It's not lower. It's not much different, but it's higher because the rates went up. Let's just say that there's no drop in price, right? Because you're expecting an outcome, and I want to show you the different outcomes that could happen. So let's just say you wait 12 months and there is no drop in price. It remains neutral, it remains steady, and it stays the same as it was 12 months prior. Loan amount the same, but interest rates are higher. Your payment is actually going up, $60 something. You're at $1,873 now. Your cash to close is a little bit higher as well, right? Because your interest rate is higher, so you have more cost at settlement for prepaid interest. But even a worse scenario, right? A worst case scenario, the prices don't go down, they don't stay the same, they go up, right? So purchase price goes up $10,000, interest rates also go up, and now you're seeing your payment go from $1,807 originally to $1,936, right? So you're almost at $130 difference right there, and your cash to close is roughly about $2,000 higher, $2,100 higher or so. So this is just kind of giving you an example, and here is like a chart that kind of shows you what's happening with each scenario, and then even more so is what are some of these long-term effects, right? So you're going to get a loan, right? Now at this point you're like, I'm buying a house, and it's 12 months later. What are the long-term effects? You can see if you wait for a drop and the house goes down $10,000 over 60 months, you're actually losing money. Over each scenario, you're seeing that cost over time is increasing to you. And then an even longer term approach at 15 years, right? If you buy now, your interest in 15 years that you'll pay is $96,976. If you're talking about this scenario, you're at $117,000. And I don't know, what anybody's intentions are, and if you're going to hold on to a loan for 15 years or even be in a home for 15 years. But you can see if you stay in that, that's about a $20,000 difference in 15 years. That's a significant amount of money. So the point I would try to make is, and you can, change that screen, Brad. The point I would try to make is that maybe it's not such a good thing to buy now, regardless of where the prices are, because interest has a lot of effect on your cash to close and your monthly payment.
So they shouldn't buy now, you're saying?
No, I'm saying that maybe it's not a bad idea to buy.
Okay. I thought I heard you wrong. I just wanted to make sure because I didn't take the presentation that way. So yeah. So look, I listen to a lot of podcasts and read a lot of industry related articles, and some of these people, they're experts, but they also speculate. But everything that I've read inclines me to believe that the price of homes is not going down. It might slow down, right? So, I don't think there's going to be a drop. And if there is, it's going to be a small drop. But what I also have read, and I've heard this over and over again, is interest rates are projected to go up next year. So regardless, if the houses drop a little bit, that people want them to, or they stay the same, or they go up, an increase in just 0.5% in interest rate, assuming that's all it is going to be impactful to the payment. It's going to be detrimental. So regardless of whether you buy a house for cheaper, the same price as it is, or for more than it is 6 months from now, rates going up can affect you big time. So if you're even thinking about it just a little bit about buying a house, now is a great time regardless of prices. And this presentation that Craig just did for us kind of shows us that the interest rates are so low right now that it makes even buying homes in this market affordable still. So that's pretty much it. Craig, do you have anything else you want to add for today's?
Well, I think we touched a lot of the topics that we wanted to, but next week, I'm going to try to stop saying and we'll have another video next week.
Here's the one thing I'll say to you and everybody else watching. We're mortgage guys. We do this. We are television broadcasters. So this part of the business, this thing we're doing right now, we got to learn and get better at, and we will over time. So who cares how you deliver it, Craig? You're giving great information to the public. And, I'm, like I said last week, and we both said last week, we're just excited to share this stuff with people to help them be more aggressive or competitive when buying, selling, or refinancing a home. So, Craig, I know you got to get on a consultation. Thanks as always for your time. Everybody that watches this, we appreciate you. If you are looking to buy, sell, or refinance a house, you can reach out to Craig or myself right here on Facebook. Send us a direct message. Our phone number to the team is 866-416-7156. Feel free to reach out if you have any questions. We're here to help. If you're a potential referral partner, realtor, appraiser, or whoever, running a business just in general, if you guys have any questions or would like to know ways we could work together, feel free to reach out. Hopefully everyone has a great day. Thanks for tuning in.
Take care, guys.
Peace out.